This module is on accounts receivable, and this is when bad things happen. So our revenue process, started with the inquiry and actually the sales process, the sales order was processed, and then we want to get cash in. That's the whole point. That's the whole goal in this cycle. And of course, we would want within revenue to have returning customers. However, we want returning customers that are paying customers. We don't want returning customers that take the merchandise and then don't pay. And in accounts receivable, in this particular PowerPoint, we're going to be talking about the bad things that happen, the interruption that gets us from the sale to not getting the cash in. And of course, we do want that cash in. And the processes that need to be involved and the safeguards involved in that process. So a few of the learning objectives then is to start thinking about accounts receivable and having classifications of accounts receivable. Now let me talk a little bit more about this. When we talk about it, we need to say that all our accounts receivable aren't the same quality. All our accounts receivable, just like all our customers, aren't the same. So whenever an action is taken within our organization that involves accounts receivable, we need to have an ability to take those accounts receivable and place them separately so that certain individuals can work on those accounts in an efficient manner. So we wouldn't lump all our accounts receivable together. And we'll go through some examples of that as we go through this PowerPoint. Second one, a negative balance, and how does a negative balance come about and what a negative balance actually means to us. So we will discuss that and what we do or how it is handled. Then we're going to talk about writing off accounts receivable, and we actually have a write-off of accounts receivable to process in our SUA. And we'll talk about documents and how we need to have documents for everything we do. Lastly, we have bad debt expense. This is separate from write-offs, and it's often confused. Students have difficulty here because they say, isn't a write-off the same as the bad debt expense? And if we use GAAP properly, we find that if there's a material amount of accounts that are going to be written off, we actually need to do an accrual entry. So we have to do an accrual entry, and there is a document that is necessary for every journal entry. So whether we are writing it off or whether we're doing that bad debt expense accrual entry, we have to have documents. Always have documents. If you are looking in your packet, in your reference materials, and this one is football, we're still operating in Chapter 3. In Chapter 3 on page 43, you will see a discussion of the estimate of bad debt expense and how that is done. And this is where we return to that bit at the end of the work in our SUA. It is technically within the cycle, but we do the work just before our financials are prepared. If you turn over to the next page, in the next page we're talking about write-offs, and this is page 44, Chapter 3, reference of football. This is actually writing off those accounts. And here it says in the action, identify the uncollectible accounts. And there will be a list of uncollectible accounts that is usually generated. And then there is going to be a journal entry which is done. So this process typically for Warren Sports Supply involves the credit department. It should be the credit department I'll say that. Identifying accounts receivable and then using that as the source document to do the general journal entry. When we go into our SUA work in this, we are going to have a letter which we are going to be receiving, and the letter is coming in from a law firm which is going to tell us that a certain university or a college is declaring bankruptcy. That in itself is quite troubling, isn't it? But we get a letter, we get a document in, and we process it. If you were to go to your transaction list, and I'm going to tell you where this is, it's going to be December 26th transaction. When you look at December 22nd, pardon me, transaction, it says no for the documents, but I'm going to tell you that technically you should have a document. So you should have a document. So there's a little inconsistency between what you see in your Chapter 3 reference and what you do when you do your work in the SUA. I'm just bringing that to your attention. There is terminology involved in this, and active accounts are accounts that are having purchases on them, and these are this is like the bread and butter to us because these are our customers that keep coming back to us. You might also think about this since you're thinking about management and what management does with it, that these are the customers you want to handle gently because you really need these customers. They are probably contributing greatly to your margins. Inactive accounts, on the other hand, are accounts that they purchased from you, but they aren't now buying from you. So what about those accounts? From a marketing standpoint, you're going to say, why did they leave us? Are they still in the community? Are they still a functioning business? And why aren't they buying from us? And so you can see now when we're talking about terminology, we're talking about flagging or classifications. It ties into our operations and how different people need to know or to be able to pull from our total accounts receivable, specific accounts receivable. If you are talking about new purchases being made, we would hope that these customers would be those that are current, that have balances or required payments that are being paid off as they should be paid. Usually it's within 30 days of the purchase. Delinquent ones, they're not paying. Would we want to make more sales to them? Would we want to do something different there? Would we want to try to get them to pay? And yes, the answer to the last one is yes, we want to get them to pay. And maybe we want to be hesitant about extending greater credit to them. And the written off accounts are the ones that are deemed uncollectible by the credit department. Again, within the SUA, you don't really have a credit department. I suppose we're going to say Ray Kramer is doing that, but Ray Kramer is also doing a journal entry, so there's an issue there. When you have a negative balance in an accounts receivable, it means you have had too many credits for your debits. And if there's too many credits for the debits and you have this negative balance, then instead of it being a receivable, it is actually, according to GAAP, a payable. So in fact, when your financials are done, it needs to be reclassified as a payable. But that is financial reporting. So a customer walks into a store, gives a valid customer number, and but tries to make a purchase here, but it's more than 3 months overdue. What should happen? Well, yes, a properly functioning AIS should have either prevented the sale or there should have been a prompt which happens that causes something else to happen. And I'm just going to create one little model of what I think could happen. When they go to checkout, they have an account with us, and the clerk at checkout says, "What is your account?" And key in the account number, and something pops up on the screen on the terminal that says, "Have the customer go over to the customer service desk." Doesn't even have to tell the clerk what's going on, just says tell the customer that the customer has to go over to customer service to process the transaction. Now when the customer goes over to customer service, the individual who's helping them there is going to see on their screen what the problem is and say, you are more than 3 months in arrearage. We need some payment today. We need something today to be able to process the sale. So a properly functioning AIS would need these flags or need something in it to prevent another sale from happening that might not be paid. And what it also does is it creates a contact point uh, between us and that customer that we can ask questions. Why haven't you paid? Maybe the bill wasn't sent to the right address. Maybe that might simply be the answer or the solution to the problem. In which case it really does assist us in turning the sale into cash. Again, the whole goal is to turn that sale into cash. Negative balances. Here are some things that could have happened. A customer overpays their balance. Our accounting system may have had an error. So we might have billed them for one amount. They actually paid the right amount according to what they were billed, but the sale was for a different amount. Or they could have paid the wrong amount to us, as the first one says. Or they could have paid for the merchandise and also returned the merchandise. So there could have been 2 credits or their allowance given. Or the last one, which is really something we need to think about and start programming in, is an account is written off and then the customer pays. So typically an AR balance that is credit means it's a payable and we need to send the customer a check. So you can see what can happen here is if a customer's account is written off and then they pay us, they end up with a credit balance, and our process is to send them a check. We are just returning the customer's payment to them. And they've gotten away with actually getting merchandise for free. And that's not what we want to happen. So in 4, whenever a customer's account is written off, we need a flag or something so that when the cash receipt comes in, we need to have the ability to reverse the write-off and process the payment. Now, how long do you wait on a credit balance before you pay them? Well, I actually worked in accounts receivable, and it was interesting because their policy was such that if there was a credit balance, they sent a check. Well, we were sending checks for 15 cents. How much do you think it costs to process a payment? Well, you have to mail it, so you've got the envelope, you have the processing of that, and you have the check form and the creation of the check form and the processing of that check. And I really don't think you can process a check for under and mail it and everything for under $2.50. So we were sending 15 cents out, but it was costing us $2.50 to send 15 cents out. So you have usually a policy in place that says if the credit balance is maintained on the account for more than, say, 3 months, and the balance is greater than a certain amount, then you send the check to the customer. Okay, so you need to have policies and procedures. We're back to internal controls, aren't we? For when a credit balance is paid off. You wouldn't keep it indefinitely, and before your financials are done, we need to reclassify that as a liability. A customer fails to pay the account, the credit department says it's uncollectible, accounting does a journal entry which is crediting the customer's account, debiting the allowance account. After that, the customer's account is 0. Now the customer comes in, they make a payment, the normal journal entry is going to credit the account again. So it's gone from having a 0 balance to now having a credit balance. And so the question is, should we send the customer a check in the amount of the credit balance? So you need a layer of controls that says if the credit balance is on the account, is it because of this write-off process? So that's another question you might put in there in your internal controls or your policies and procedures before you send the customer that check. For us, we need to reverse this journal entry before we do this journal entry. So that's something that needs to happen. How would you change the AIS to prevent that payment? And we just discussed that. Write-offs are a credit department decision. How do we do that? Is it a certain number of days in which they are uncollectible? And then the authorization of it, and make sure that the collection efforts have been made and it's not, say, someone's friend that they're just writing off so they don't have to pay. The documents need to support this. We have to have that audit trail. Record keeping needs to be happening. We need to flag it. If we're sending it out to a collection agency, you need a whole procedure for that. So a company can write off an account, but that means that our credit department believes we cannot collect on it. It doesn't mean that someone who is a specialist in collections couldn't get a collection on that account. So we send it off to a company where we have individuals that are specialists in locating these deadbeat customers and getting them to pay. And that's a collection agency. A collection agency usually will take a percentage of whatever they collect. So we're still going to have a loss, but it's going to be something that's going to be helpful. The segregation of duties or separation of duties, the one who records the sale or writes off the account is not going to be the one that is also going to authorize everything that's happening or handle the collection efforts or do the journal entry. We need to have CAR in this function. The journal entries, which you do, we just went through a moment ago. The expected document is a list of uncollectible accounts receivable. That has to be there. We don't just do a write-off on an accounts receivable. We have some sort of authorization document that tells us what to do. Now, in your SUA packet, I believe there is a bankruptcy notice. There's a bankruptcy notice. That's a document. And it's coming from an outside party. If you have documents coming from outside parties as evidence to do the journal entry, this is the best evidence you could have. It's even better than the list of uncollectible accounts receivable that would be coming from inside the company. Another thing which we do is an aged balance of accounts receivable. And the major purposes in this is to help us make sure at the end of an accounting period that everything is reconciled. Our control account agrees to the subsidiaries. When we do our work, we post a subsidiary first, and we do the control account journal entries at postings at the end. And so we need to make sure that those are in order before we do the financials. Management can look at this aging and say, what's happening? Are our ones that were 30 becoming 60 for this period of time? Or are the 60s day delinquents now becoming 90? Or are we making collections? Are the customers paying? What's happening? What's the quality of our accounts receivable? Because this tells us something about the quality of our credit department. Are they doing a good job in turning away the applications for credit that they should be turning away? Are they accepting too many? And it also tells us if our allowance account, this thing that we accrue for at the end of an accounting period, if it is adequate. So here we have the allowance for doubtful or uncollectible account balance, and it's helpful if you review that the actual is the left side and the estimated is the right. So if you have trouble with understanding the allowance account and the journal entries associated with it, I suggest you review this. It's just something from financial reporting. Bad debt expense is something that needs to be done, and it is done at the end of a time period before financials are done. You want some similarity between what is expected as a bad debt expense and the actual write-offs. And the auditors are going to look for support for this accrual journal entry, which is done, again, before financials are done. And they're going to want some sort of a document that says, this is how we came up with the number. That's what they are going to expect.